A stock that doubles can certainly make a lot of money for you, but there are rare stocks that can rise 5 times or even 10 times, and those are the ones that completely transform your financial future for the better. That is why I want to focus this video on 5 unique stocks that have a realistic shot of achieving that life-changing upside before 2030. There are 3 keys for making that happen. First is that each has truly strong growth potential. Second, they are currently undervalued, helping to pad those final results. And third, each scores elite grades in our proprietary quant model that points to the most fundamentally sound stocks, the type of stocks more likely to enjoy beat and raise earnings results, helping to push shares ever higher. We will start with Daktronics with a symbol of DAKT. Now, we'll do that in just a second, but before I dig in, let me quickly tell you who I am. I'm Steve Reitmeister, but everyone calls me Righty. I've been investing for over 40 years, and I'm a partner at WallStreetZen.com, where our quant rating system identifies stocks with the highest likelihood of outperforming the market. Before we move on, if you like this type of video content, then please go ahead and tap that like button. It tells the algorithm to show you more videos like this in the future. Now, back to that first stock in Daktronics. Most people draw a blank on the name, but I guarantee you've stared at their product before. That's because they make giant LED video screens, like stadium scoreboards, the highway billboards, message boards at the airport, and so on. If it's a big, bright screen out there in the real world, there's a good chance Daktronics built it. Now, Daktronics came from a stock screener our team built on WallStreetZen.com for exactly this kind of hunt called Potential 10 Baggers. I'll put a link to that screener in the description below. Everywhere you look, the old fixed signage is getting torn down and replaced with programmable LED. Stadiums are upgrading their scoreboards, retailers and highways going digital, and that replacement cycle runs straight through Daktronics. Not to mention they have ample international expansion opportunities as well. The proof of all this extra demand showed up strongly in the most recent impressive earnings result, 35% above expectation. Here's the setup even more interesting than all that. Investors aren't being asked to pay a crazy price for all that growth. Daktronics trades at a PEG ratio of about 1.1, whereas the average stock right now is much, much higher at 1.5 PEG, right? That is a nicely undervalued and allows us to get in shares at a hefty discount to enjoy all that growth. All right, we got the growth, we got the value. Now let's see what our quant model says about Daktronics. After a full 115-factor review through the Zen Ratings quant model, it scores a strong B grade, which amounts to a buy recommendation because of high odds of share price outperformance. Note that our coveted A ratings are only given to the top 5% all stocks, whereas Daktronics is just a notch below in the top 6%. So maybe it's better said that this is a B+ stock, all right, or A-. And beneath that overall rating are 7 component grades that show us exactly where a stock is strong or weak. Now, gladly, Daktronics has a pretty well-rounded, attractive profile. That starts with top 21% of all stocks for financial strength. Value jumps up a notch to the top 17% all stocks. Sentiment climbs to top 14%, which says the smart money is clued into these shares. And then we have safety in the top 11%. Rarely does safety come alongside growth, which is a big positive when it does come together. All in all, we have an under-the-radar company smack dab in the middle of a thriving industry in large LED displays. This points to outsized growth potential. Now add on top the great value proposition, and finally the strong showing from our Zen Ratings quant model that greatly increases the odds of future outperformance. This is a great way to start our video today, but stay tuned as the 5 stocks just keep getting better and better from here. Now, a quick aside before I continue: if you enjoy discovering exciting stocks aligned with current market events, then the best thing you can do for yourself right now is to sign up for my next live training session this coming Monday. Now, the focus is on timely market insights plus my top picks. It's totally free, but you do need to sign up. Do that now to join me this coming Monday. Just go to WallStreetZen.com/live. Daktronics is the quiet part of this list. The next name, not so much. That brings us to Corcept Therapeutics with a symbol of CORT. For years, this was a one-drug company and that drug treats a serious hormonal disorder. The body making far too much of the stress hormone cortisol, right? That's where the name comes from. A solid, profitable business, but here's why the timing to get in the shares is getting pretty exciting right now. Earlier this year, the FDA approved their second major drug, a cortisol therapy for hard-to-treat ovarian cancer, and the early launch is running very strong. That led to a massive earnings beat. The street was only expecting 2 cents per share, and yet they came in at 36 cents. Yeah, 18 times higher. Plus, management felt emboldened to raise guidance massively for the future. Of course, shares sprung higher on that stellar earnings beat, but clearly, I see a lot more upside for Corcept, or they wouldn't be in the video today. That starts with the earnings growth forecast calling for 130% increase in the year ahead. That is literally 10 times higher than the industry average. advantage. A big part of that growth picture is that their new second drug is hitting its stride, but also they have got another new drug application for the FDA and more cortisol-based candidates behind it in the pipeline. The more drugs they have driving growth, the more shares will soar from here. Yes, this is a risk, but it's also a massive opportunity. Wall Street is bullish on these shares as well, but what really catches my eye is who is so bullish. 3 of the analysts covering Corcept rank in the top 5% of all stocks we track based upon their actual stock picking performance. That matters because buy recommendations sometimes are kind of a dime a dozen, but when they come from analysts with a strong track record of success, then it's worth paying attention to. The Zen Rings model likes it even more than Wall Street. That's because Corcept earns an elite A rating, which is reserved for the top 5% of all stocks after that full 115-factor review. In this case, they actually land the top 1%. Yes, this means they score higher than 99% of the other stocks in our system. That's a great start to any investment conversation. Now let's pop the hood and see what's underneath. Value comes in the top 19% based upon 21 different measures of value. Sentiment and financial strength both score in the top 15% of all stocks. Momentum, the top 6%, proving that these are timely shares. And the standout grade is for growth in the top 4%, which greatly increases the odds of future beat and raise earnings report that boost shares even higher. The honest risk. A recent court decision cracked open the door for a generic version of that original hormone disorder drug, so that revenue stream faces pressure down the line. That's the whole reason the second drug in the pipeline of other drugs matters so much. If the cancer franchise continues to deliver, then this company will look dramatically bigger by 2030. As will the share price. But on the whole, you've got a potentially explosive growth story unfolding, yet ability to buy it at an attractive discount. You also have the smart money on board. This very well could be a good prescription to see stellar gains in Corcept shares in the years ahead. Let's forge ahead to our third stock in Generac with a symbol of GNRC. Now, very likely you recognize Generac as the backup generator company. Now, when the power goes out and your neighbor's house is the only one on the block with the lights still on, odds are there's a Generac generator humming away in their yard. But that's just one part of the story here. Generac has expanded into batteries, solar, and smart energy management. And now it's moving to data center backup power. Yeah, meaning they are supplying the massive system that keep AI facilities running when the grid goes down. This is a big part of the excitement in these shares right now. The last 2 quarters have shown serious flex muscle during earnings season. First was a 35% earnings beat going back a couple quarters ago. This led to a massive increase in estimates from the street. And yet they had no problem leaping over that hurdle once again with a 50% earnings beat in the most recent quarter. Even better is knowing that there is a lot more upside growth ahead, as the street is expecting 45% earnings growth going forward, right? They've been doing really well, and that party is going to continue in the future. Comes one of the best parts. We get to buy shares after a 30% decline from their highs. We are getting to buy the dip as one of the best stocks in the AI-related camp. The share price may have come down, but the future earnings prospects have only gone up. And that makes for a super compelling investment opportunity right now. Wall Street loves these shares. 11 strong buy recommendations on board. This includes a lot of price targets that point to great outperformance in the year ahead. And no doubt that the growth party continues, those fair value targets will only go higher, leading potential multi-bagger gain by 2030. Our quant monitor most certainly agrees with the bullish thesis here. Generac earns a coveted A rating, putting in the top 2% of all stocks we track. Now, stocks with this top-tier A rating have historically outperformed the S&P 500 by nearly 3-1. And when you dig into the 7 component grades, you get to see exactly what's driving this elite ranking. Value comes in around the top 24%, no doubt that has improved after the recent dip. Safety in the top 16% of all stocks. Sentiment, that smart money indicator, in the top 13%. Financial strength, top 9%. We have a truly strong balance sheet and stellar operational metrics. And the standout grade, as it should be in any long-term pick, is growth in the top 2% of all stocks tracked. The one thing to watch, a lot of the growth story now leans on a handful of big data center customers, so any slowdown in that spending would be felt. But right now, the AI spending is ramping up, which provides serious growth potential in the years ahead. Now tack on the buy the dips value story and elite Zen Rings profile, and you have a stock that could really go the distance. It's exactly for these reasons that I recently added Generac to my Zen Investor newsletter portfolio. This is where I feature my top 20 handpicked stocks for the long haul, and Generac is one of my favorites at this moment given tremendous upside potential. So consider if it has a rightful place in your portfolio as well. Now, our next name proves that sometimes the most boring sounding business can hide the most interesting investment setup. Quick ask before we get to that next stop. If you're getting value from this video, then hit that subscribe button. That's because I publish data-driven stock analysis like this every single week. And if you like what you're seeing now, then you don't want to miss what's coming next. All right, stock number 4 is DHI Group with the symbol DHX. Now, please don't get it confused with another ticker that goes by DHI. So for clarity, I will reference it as DHX going forward. This one has the most boring sounding business on the list today, yet one of the more interesting investment setups. That's because DHX runs specialized job boards, 2 platforms including DICE for technology professionals and clearance jobs for clearance jobs, which is the part that really matters. It's the go-to hiring place for people who hold U.S. government security clearances, right? Defense, intelligence, classified work, all that stuff. You can't try and fill those jobs on Indeed.com, right? This is a very specialized area, and that is the interesting economic moat around this business model. With defense and government spending climbing, as it always does, demand for cleared talent climbs right along with it. DHX is doubling down on their clearance advantage by adding a recruiting firm to not just post jobs, but to fill them as well. Now, the benefit of their model shows up in their earnings beat streak of 9 straight quarters. Now, the last 2 quarters have been the most impressive, averaging a nearly 65% earnings beat per quarter. The Wall Street coverage here is surprisingly large for a company this small. I'm talking about a company that only has a $165 million market cap, but they have 3 analysts, all ranked the top 20% of their peers for stock picking performance on board, and each one proudly waving a buy or strong buy recommendation for these shares. Every one of their fair value targets sits significantly above where the stock trades today. This includes a street high target price that calls for, get ready for this, 160% upside in the coming year. Again, that is only for the year ahead. No doubt, much more upside is expected as we look out to 2030. All right, now it's time to discover what our system has to say about these shares. And as you likely suspected by everything else we've talked about, yes, this is another elite A-rated stock according to the Zen Ratings model. That's because after analyzing the stock across 115 fundamental and technical factors, it scores in the top 1% of all those stocks. Yes, better than 99% of all the stocks reviewed. Now, let me walk you through the component grades to demonstrate what makes it truly stand out. Value comes in the top 18% of all stocks. This is based upon 21 different measures of value. Growth is a top 16%. Momentum, top 15%. Always good to have momentum alongside value to increase timeliness, right? Financial strength in top 10%, and the standout grade is sentiment, the top 7% of all stocks. This tells you the smart money is already paying attention. The risk is straightforward. DHX is still a small company that comes with a little extra volatility in the share price, but the potential reward is so much greater than that risk. Not just the growth, not just the strong review from the quant ratings, but also the top Wall Street analysts pounding the table on a great value story with massive upside potential. Before I get to the last stock that could be a multi-bagger going to 2030, just have one last thing for you. If you want to stay one step ahead of the market, then join me live every Monday. That's when I share my updated market outlook and trading plan to outperform. It's also when I unveil my trade of the week based upon the proven Zen Ratings quant model and my greater than 40 years of investing experience. It's a free event, but you do need to register. Just go to WallStreetZen.com/live or click the link in the description or scan the QR code on your screen. Just pause the video for a moment to sign up. I'll be patient and wait for you. And then I look forward to seeing you there on Monday. If you're a regular viewer of my videos, then you know I like to save the best for last. And here's something that you almost never see. A company that spent years as a cash-burning science project with no approved product, and then one approval flipped the entire story overnight. I'm talking about Precigen with a symbol of PGEN. This is a gene therapy company, and last August, everything changed for the better. That's when the FDA approved their lead therapy for a rare, painful airway disease. It's the first and only approved treatment for that condition, and the FDA handed them 7 years of market exclusivity. So no competitor can come around in that time period, right? A protected runway for a first-of-a-kind medicine. And the launch is ramping fast. Revenue is forecast to grow around 70% a year going forward. And if revenue is growing that fast, you can only imagine what that means for earnings growth. That history of burning cash is now over as the company has headfirst into profitable territory, and that will ramp up big time from here. Yes, it's true that investors are starting to take notice with shares up nicely in the past year, yet the outperformance party looks far from over. That's because the approved drug may only be the opening act. Precigen is already seeking approval in Europe and expanding into pediatric patients. And there is more behind it. A second drug is already in mid-stage cancer trials with new data expected year-end. The product that made Precigen profitable could be just the first off in a line of a lot more to follow. The small cap is pretty light coverage from Wall Street at this stage, yet all analysts on board are calling it a buy recommendation. My favorite call is coming from the analyst at H.C. Wainwright & Company, who ranks in the top 2% of all analysts for his stock picking performance. His fair value target, just like the last stock, is looking for 160% upside in the coming year. Again, this is coming from an analyst with a truly stellar track record of getting it right. One of the best uses of the Zen Rings model is for smaller companies with light Wall Street coverage. That's because the 115 factor review offers great insight into their fundamental and technical makeup. That's why it's so nice to hear Precigen earns yet another elite A rating, because it scores in the top 1% of all stocks we track. Now, as you might expect, it also leads to top-tier component grades for this stock, starting with financial strength, the top 24% of all stocks, momentum, top 12%, the AI grade, first time we're talking about that one, top 10%, and that factor measures how likely a stock is to outperform based upon our usage of AI to find unique patterns in the data, right? Sentiment is top 6%, and the standout grade, as it should be for any long-term stock, is the growth grade, top 1% of everything in our system. That is a great sign of much more growth and upside to come. I have to be straight about the risk. Safety scores in the bottom 6% of all stocks. This is a small biotech company, and that's bound to be more volatile for sure, showing up in that safety rating. But here we have an emerging biotech with one big win on the board and lots of potential packed into their pipeline. Now consider that Wall Street support an elite Zen Rings profile, and there is good reason to believe in this stock's home run potential. So there's your list of 5 stocks with exponential upside potential heading into 2030. Now remember, the Zen Rings are updated daily, so be sure to visit the quote pages on WallStreetZen.com to see the latest ratings for these or any stocks before making any buy, hold, or sell decisions. It's a good idea to bookmark the site now for all your future visits. Now I want to hear from you. Which of these 5 stocks do you like the most? And is there a name with this kind of upside that I didn't mention? Share it with our community in the comments section below. And if you're not sure what to do next, then I suggest checking out the video that's popping up on your screen right now. In that one, I break down 4 under-the-radar small caps worth a closer look right now. Go ahead and check it out.